The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Shea with Steve Sedgwick, and these are your headlines. Wall Street retreats, the S&P 500 breaking a 7-day winning streak after the Fed's preferred inflation gauge edges up to 2.3% in October. ECB President Christine Lagarde calls on Europe to engage with Donald Trump on tariffs, urging leaders to avoid retaliation.
Uniper, meanwhile, raising its full-year outlook after settling a number of legal disputes, allowing the German energy group to release provisions. And how about this? A bit of potential M&A, not happening at the moment though. Direct Line rejecting a £3.3 billion takeover offer from rival Aviva, saying the offer substantially undervalued the company. How you doing?
I'm very well, thank you. How about you?
I'm all right. And if you are American or in America watching the show today, you're supposed to be relaxing. But if you can relax and watch the show, we'll let you off because we're Thanksgiving territory.
Exactly. Have some turkey for us.
Yeah. And are you doing your big party? You do a big. No. You used to do a big Thanksgiving party.
I used to.
then there was the cost price inflation.
Exactly, and the turkey went
just
up.
pare it down just
and
so the close family.
And the sides went up, and
Meanwhile,
the decorations went up, and then suddenly.
Have you put your Christmas decorations up?
No, but I'm currently ordering a fresh tree.
Are you?
Yes.
Very good. I've got a couple of old plastic ones in the loft you could have had. I'm in a duel at the moment though, as indeed is every consumer out there on the planet. A duel with a retailer of a certain product, and I'm waiting for them to get the price down for Black Friday, and they're waiting for me to pay the full price. And I think there's a lot of that going on,
so
especially
far, neither
this
of you
year.
are winning. You haven't got the product, and they haven't sold it to you, so it's lose all round.
No, I lose because I need the product in time for Mrs. S's birthday.
Oh.
So
they've got you over a barrel then.
They've got me over the barrel.
The wife's birthday is all important. You're just going to have to pay up.
No, it's
if you haven't had the promotion yet, it's not coming. I mean, what point do you think it's going to come? Cyber Monday?
Japanese brand of sneaker, which narrows it down a bit.
Well, if it hasn't been discounted, then it's going to be purely a New Year's Day, Boxing Day rather, sale, isn't it? Next year into next year.
Her birthday's on the 1st of December.
Yeah, that's not going to work. You've got to get going.
Should we get back to the data? The US PCE Index just deflated me straight away. Well, unlike the US PCE Index, there you go. The Fed's preferred inflation gauge, which ticked higher. It inflated rather than deflated, slightly higher in October, albeit in line with expectations. It showed a 12-month inflation rate of 2.3%. and 0.2% month on month. The core reading, excluding food and energy, rose 2.8% on an annual basis and 0.3% on the month. Jobless claims. You know, those of you out there who think that the US jobless market or the jobs market is really shaky, I need to see more evidence to back your view. Let's be brutally honest about it. The number of Americans filing for jobless claims fell again last week, coming in at 213,000. Continuing claims, this is the same as last week. You could almost cut and paste what we saw last week. Continuing claims, however, ticked slightly higher. Again, we said the same thing, suggesting that laid-off workers are finding it difficult to land new jobs. Elsewhere, the data prints have markets now pricing in a near 70% chance of a 25 basis point cut at the Fed's December meeting. I don't see how that data, those two pieces of data alone, Karen, actually back that view that the Fed is definitely going to cut again.
That's what I thought. I had a bit of an eyebrow raise as you were reading that because the pieces don't really seem to come together, do they? So are those expectations still too strong around rate expectations? So when we take a look at the US markets, I think the breaking news was that the market went down. We've had day after day where the market has been climbing, in contrast to the European markets where they have been very much showing a loss of momentum. So these markets over the course of the month, very, very strong, but in session yesterday, down to the tune of 1/3%. 0.5%. Again, modest treat on the S&P and the Dow that have been leading towards those record levels. The Nasdaq down 0.6%, not back at its record in recent trading sessions like the other two major boards, but still very close, just a whisker off records. But you could see a flip into negative territory for these major boards. But in terms of how far they have climbed for the month of November, 7% higher so far for the Dow for the month. Two treasuries and what we're seeing on those boards, assessment around the inflation numbers, you can see we're just a little bit lower with March South, 4.23 on the 2-year, and we're 4.26 at the 10-year. The dollar as a result of that slippage in yields. Let's just take a quick check. You can see euro dollar, though, still struggling to get a foothold versus dollar in the morning session of 0.2%. Slippage too on the sterling trade. Cable trades 126.57. Dollar stronger versus the Japanese yen and also versus the Swissy. So across the board, dollar is king this morning. The Asian markets. Well, we've been talking about tariffs and they've wobbled pretty much every market except those US boards that were down yesterday. But more broadly, it's been global markets that have been on the back foot as a result of some of those fears. The Nikkei trades up today, so you managed to claw back some territory. Shanghai, Kospi, all just leaning positive. But we are seeing, again, more red on the Hong Kong market that trades down 1.2%, Steve.
Let's get to Michael Yoshikama, who we can speak to because it's not officially Thanksgiving in San Francisco yet. It is actually still 10 p.m. on Wednesday. So I don't have to say, why on earth are you working with us on Thanksgiving, Michael? But anyway, in advance of that, happy Thanksgiving. How are you and how do you feel about these markets?
I'm fine, thank you very much, and happy Thanksgiving to you. And I feel pretty good about the markets. I think that the prospect of tax cuts certainly is prompting rallies in the market. And until we see negative news about tax cuts, in other words, it's not going to be quite as intense as people are thinking, I think the markets are going to be rallying. The inflation number is reasonable. I agree with what you and Karen have kind of been talking about, which is it's hard to really see, though, and this might be a risk for the markets, that there's really an environment right now that makes clear sense to lower interest rates. And so I'm of the belief that you're going to see a slowing in the dropping of interest rates and maybe even just a stall, with the possibility down the road, if inflation kicks in because of tariffs and tax cuts, that we may see higher rates. So I would be very careful betting too heavily on falling rates at this point.
Michael, I hate roller coasters. I just doesn't agree with me. But everyone says, we're on a roller coaster. But I don't think we're on a roller coaster. I think we're just on the up bit at the moment before you get that enormous precipitous drop and then the roundabout stuff and what have you. These markets are wonderfully steady at the moment in the United States. The gains on a 5-year basis are on the screen are extraordinary. The gains on a 1-year basis are extraordinary. Are we on the edge of not a downtick, but actually a more volatile period? Because it keeps getting called and the VIX keeps going down.
Yeah, I mean, obviously, anytime the market goes higher, valuations get stretched. And when valuations get stretched, you have more market volatility. I think in particular, the first quarter here in the United States is going to be all about...
Sorry to jump in. That's not always the case. What the US is doing is growing into those valuations, unlike European corporates, unlike a lot of UK corporates as well. I just wanted to come on that point because I'm like you. I think, if we keep going up, the valuation is getting stretched. But what the US earnings appear to be doing is growing into those valuations.
Not fully. Not if you look at it. They are, I mean, they're not as stretched as you might imagine because, yes, there is growth in earnings. There is growth in market share for many U.S. companies, but they are still getting stretched. I mean, if you look at if you look at the earnings numbers and you look at where valuations are right now, the market is not, I'm not saying it's all exploding upward, but I think there's really kind of a positive bias in the markets right now. So I still think you need to be careful. I mean, just look at some of the tech stocks, some of the AI stocks that have taken a breather here. It's an example of companies that are growing into their earnings, but maybe valuations get a bit stretched. Maybe people are a bit too optimistic.
Michael, to your point, I want to just take you to the TDEX. So this is the nation's Taildex Index, because the crash protection squad is out there. We're not seeing it in the VIX, but we are seeing it elsewhere. Also, the CBOE skew. There's some elevated concerns out there, and that is forcing people into some sort of protection in case there is a big move in the market downwards. What do you make of those early moves? Is it warranted to take some protection if you've been long stocks at this stage?
Yeah, I think it is warranted. I think at this point, Karen, to not just hope it's going to continue to rise, because that volatility that we talked about, as I mentioned, despite growing into earnings, there's still a stretched valuations in my view. And I think that what you're starting to see in the volatility indices, even though the VIX is not really a good volatility index, really, in my view, to watch, I think there are concerns in the market. And I think when there become these sort of concerns, it creates an environment where people are waiting for the first piece of bad news. That's really what this does. It's not a sign the markets are going to go down, but it's a sign that market anxiety is higher, which means the negative news is going to be magnified. And that's something investors need to be aware of, and maybe insulate their portfolio, maybe take some profits from their high rallying positions, and circle the wagons just a bit.
Michael, you've always been an international investor. I was starting out my morning looking at some commentary from one investor saying, look, we are now only in US equities because we think we can get that exposure risk in international stocks listed on the US markets. We don't need to actually invest in international stocks. What do you make of that view? It's US stocks only now, get rid of the rest of the international basket of names.
Well, I wouldn't get rid of them, but I'll tell you, Karen, we've been investing on that assumption for like 8 or 9 years. And for 8 or 9 years, I'm sure you had people come on the show and say valuations relative, let's say, to emerging markets versus US are at all-time wide spreads. And so therefore you have to, I just don't really buy that complete argument. And I think there's a lot of investors out there, a lot of viewers who have kind of bought into the standard allocation model where you have a third or whatever number you have in international investments, when 50% of the revenue in US stocks comes from where? It comes from outside the United States, right? So I think if you have US stocks, you're already 50% out of the United States. And then if you add in international stocks, and particularly some of the darlings in the past that have really struggled for good reason, in my view, like China, I just think there's just too much overweight. I don't know that I would go all US, but I certainly would not be, we certainly are not investing the billions that we manage with this really heavy overlay of international, because we think the market is just now global and you can get diversification even in a US stock.
Wow, that is interesting, Michael, and explains the underperformance we're seeing in a lot of European names. That said, I mean, what would be the catalyst for international investors, do you think, to shift their attention to some of those international markets? I mean, French stocks have been marking lower for weeks and weeks and weeks. What would change some of the psychology, do you think?
Honestly, Karen, I don't know. I don't really actually know. I mean, I suppose maybe the settling of what's happening in Ukraine, certainly the ceasefire that's happening in Israel is helping a bit. I think the Ukraine situation would maybe calm energy prices down a little bit, and that bit might be a tailwind for European economies. As far as emerging Asia, where you were for many years, they're really struggling. And so I guess the short answer is I really don't know what the catalyst would be. I don't really see one really here on the horizon that would really suggest that if you wait for this one trigger moment, all of a sudden you pile into international, because I still think US equities have an advantage because of transparency, dividends. They're in tech sector, which is obviously a huge growth segment of the economy. So I don't have an answer for you, but I would say that I'm not terribly optimistic that there's going to be some trigger where everybody's going to rush back into international investments. Everybody's been saying that for 7 or 8 years. And I mean, every year it's like the same old story. It's like, this time we're going to do it. It's like, this time we're going to do it. It's like your worst nightmare soccer team that says they're going to do better next year and they don't.
I know a thing or two about worst nightmare soccer teams, Michael, but that's enough about my personal problems. Michael, I was talking before we got to you about my battle with the retailers. The retailers winning at the moment, no doubt about it. This is such an important holiday season for the retailers and for gauging consumer confidence, which remains at multi-year highs. In fact, Carl Weinberg, another contributor of ours, was saying that actually the confidence levels are very similar to the middle of 2007, which is ominous in itself as well. How's this one going to play out, Michael?
I think it's going to be a pretty good holiday season. There is just so much money floating out there right now. We see it from an investment standpoint in terms of investor flows, just talking to people. people have more money. House prices are up here in the United States anyway. House prices are up, stock values up, 401ks are up. So I think it's going to be a good holiday season. It would surprise me if it was not. Of course, always the game we play, right, is how good is really good. It's an expectation game, right? So what I think right now is people are cautious about the holiday season, and I think what's going to happen is you're going to see numbers, at least from the checks that we've done, that are probably going to exceed expectations, give upside surprises, even if we have some downturn, down retail reports from some of the retailers. I think overall, from a sector standpoint, the consumer has money. Yes, I know they have a lot of debt, but they're willing to crank that debt up. So I think it's going to be a good holiday season, which may, this is the confusing part, may trigger fears of inflation, which then makes people fear that the Fed will raise, which then will cause stock prices to go down, even though stocks are doing well because earnings are solid because of stronger Christmas sales, if that makes any sense.
It does, Michael. You've given us a lot to think about over Thanksgiving. Thank you very much for joining us today, and happy Thanksgiving. Happy holidays to you. Marco Yoshikami with us, founder and CEO, Destination Wealth Management. Coming up on the show, ECB President Christine Lagarde says the EU should negotiate with President-elect Trump to avoid a trade war. What's they saying? Buy America. Plus, US retailers gear up for a vital holiday weekend with a record number of shoppers expected to splash the cash. And we'll discuss geopolitical risk and recent damage to undersea cables in the Baltic Sea with the Finnish Foreign Minister. That first on CNBC Conversation, coming up at 8:15 London time.
Uniper raised its full-year outlook after settling legal disputes. The German utility says the settlement will release funds that it previously set aside for litigation, but did not specify which case it was. In June, Uniper won a multi-billion euro case against Gazprom. ECB President Christine Lagarde says the EU should show willingness to negotiate with the incoming Trump administration when it comes to tariffs. In an interview with the Financial Times, Lagarde said it was, quote, net negative for all to have a trade war, suggesting European countries could purchase more LNG and defence goods as part of a cohesive approach. We'll come back to this a little bit later on. South Korea's central bank surprised the market, remember that bit, with a second consecutive 25 basis point rate cut, lowering its benchmark rate to 3%. Sherry, good morning to you. You know loads about this stuff, and I know very little about this stuff. So I've just been looking at the great copy from our colleague on CNBC.com about this as well. And I'm surprised that anyone's surprised. When I look at the export figures, I look at the growth figures as well, it seems entirely logical.
Exactly. And the export volume figure, and in the last quarter, South Korean economy barely grew. And just this week alone, we saw South Korea's November consumer and business sentiment dipping. And all that surveys actually talked about the Trump 2.0 and related uncertainty. So surprise move just because of the timing of it, because we were thinking the BOK would be more careful in terms of messaging, prime the market with some downgrades when it comes to growth and inflation, and then go for another cut in this rate cutting cycle. That was really it. So yes, I'm really hesitant to call it a surprise move, but looking at the market reaction, the market was surprised because they thought the BOK would be careful and a little bit not so rushed, not so front-loaded with rate cuts. So we've got the Korean won as well as the South Korean government yields actually lower. The reason why the market consensus was really built around a dovish pause this time around was the recent weakness in the Korean won. So recently, I mean, just this earlier this week, it was actually to 1405. So breaching that 1400 level is really the psychologically important level, and that takes us back to the level that we saw in September-November period of 2022 as well. So I think that's why the market was safely calling for a dovish pause here as well. What happened? It's really the Trump 2.0, and it's really a lot of policy uncertainty coming from the new U.S. administration, according to the statement as well as governor's words today. And in fact, Governor Lee Chang-yong did talk about two things here. So he didn't really see the BOK didn't really see the Republican sweep on top of the Trump election win. So that means a lot of policy uncertainty. And for South Korea's problem, it's really the export problem. Export volume for the third quarter actually fell lower, came in lower than expected. And their assessment is that this is not a temporary problem. It could be structural. So I think that can explain today's action as well. When it comes to the BOK's projection for growth and inflation, which was expected to come down, they delivered on those expectations for this year and next. So it's really the BOK bracing for Trump 2.0. Guys?
Sherry, thank you very much for that. Let's push on to some tech, as Orange has agreed a multi-year partnership with OpenAI in Europe. The deal makes it the first European telecoms firm to have direct access to the AI startups on pre-release models. Now, Orange says more than 50,000 employees currently use OpenAI models. So first mover advantage is what they're hoping for.
Oh, hang on. Have we noticed in the Orange numbers extra profitability?
Right.
This is my point that I've been trying to make for ages about when a company adopts .com or a company adopts emails. They are brilliant. They are great for your productivity. They keep workers working when they're at home, which we shouldn't do. But the point of the matter is brilliant. It's great. It will be great for Orange, no doubt about it, I'm sure.
Yeah.
But will we notice it in the profitability, or will it just be absorbed into the cost base so they can cut costs somewhere and increase costs elsewhere?
We've got to do this later because we've got Lynn staying, but I do want to talk about this one. Now, the SoftBank CEO, Masayoshi Son, has met with Indian Prime Minister Modi and tech founders in the country, as well as part of a two-day visit. Now, the CNBC TV18 has reported that SoftBank CEO told founders India could play a pivotal role in shaping the global AI landscape. Well, let's get out to Lynn for more on this. Lynn, just walk us through the role that India wants to play in the AI landscape.
Yeah, hey, Karen. So, as our regional affiliate has been reporting, certainly some big names and more heavyweights, including Mukesh Ambani, who is the MD of Reliance Industries, the richest man in the country as well. And as our affiliate was talking about that, we have seen Masayoshi Son. He has been investing aggressively into the Indian market. And analysts say to me that, this is not really a surprise because he sees great potential in terms of what that market, which of course is still a growing market, could do, particularly in the AI space. Masayoshi-san is very thematic when it comes to his investments. He's made it pretty clear that this is really his focal point going forward. And he's spoken, and we should say that, analysts have said that, this market is seen as potentially that beneficiary in the geopolitical landscape vis-a-vis China. We know that SoftBank also in recent years has been selling down a lot of its stakes that has Chinese exposure as well. And also we know that it's a country that has also, the talent here, particularly from an engineering perspective. So these reports suggest that he really sees a lot of potential when it comes to the country in terms of that chip design. But also, of course, it's another sign of wanting more of that AI exposure. And of course, yesterday, CNBC first reported that it is looking at that $1.5 billion investment into OpenAI via a new tender offer, according to sources there. So really a doubling down of that. Let's not forget as well, just a couple of weeks ago, that partnership with NVIDIA as well.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.